It's easy to punch someone when we're angry or elope when we're overwhelmingly in love, but acting on our feelings isn't always the best thing for us or for our future. In fact, when we get carried away with our emotions, we sometimes make bad decisions that we later regret. And that's the same thing when it comes to money and investing. You might feel sad, worried, or afraid when you see the market going down, or happy when you see the market going up. And that's perfectly normal. You're only human after all, so you're entitled to your feelings. But the difference between a successful investor and an amateur investor is how they act on those feelings. An amateur investor will feel scared and pull the plug on their investments. An amateur investor will also feel excited and go all in on their investments. They take actions based on their emotions. What do you think successful investors do? Right, the opposite. Successful investors keep their emotions in check and act logically. They look for hard data and specific information about the cause and effect. Then they take that knowledge and they make a decision based on predetermined rules and principles that they set for themselves. They follow a process. Let's go over a real life example. Just last year, in October 2022, Meta, the parent company of Facebook, Instagram, and WhatsApp, was selling in the stock market for $93 per share, which was previously selling for $384 per share. During this time, there were so many negative news about Meta. People were saying that Meta was dead or the company was dead and that the CEO was no good. I even had someone personally tell me to be careful because it could end up like MySpace, which was another social media platform that no longer exists. Amateur investors panicked and sold their shares, which drove the price of Meta even lower to about $88 per share. Other amateur investors were too afraid to buy the stock because of all the negative news going around. They found the stock a risky investment. Meanwhile, successful and experienced investors were buying shares or more shares of this company. I was a buyer too, and here's why. I learned from successful investors to keep my emotions in check, stay calm, be logical, and do my own research. Instead of listening to all the negative news and being afraid of what others are saying, I took this opportunity to look at the company's financial records, like their income, expenses, their debt, their investments, etc. Meta's financial status has been consistently good, and their products and services were well received by their customers. I remember thinking, how could someone say that the company was dead or dying when I noticed that my parents' generation are hooked on Facebook, my generation are obsessed with Instagram, and a lot of people that I know overseas are heavily utilizing WhatsApp, all of which are owned by Meta. Then Meta's revenue was growing, their profit was good, and the return on their investments were great. So, what did I find during my independent research? A great company that was selling for less than what I thought it was worth. It was like finding a beautiful home that was worth 1 million but was selling for 500,000. Meta passed the set of criteria that I look for in companies. So, in online dating terms, I swiped right. But seriously speaking, I still felt that fear that others might know something I didn't. But as I learned from successful investors, I put my emotions aside, I followed my process, and bought Meta shares. Then, 12 months later, the stock price went back up to $300 per share. During this time, all the negative news about Meta turned into good news. The amateur investors were excited again because the price kept going up and they wanted in on it. The fear of missing out is real. The higher the price went, the more attractive the investment became for amateur investors. Amateur investors tend to believe that price only goes up. Meanwhile, successful and experienced investors have stopped buying, and so did I. The more the price went up, the riskier the investment became. At that point, my process no longer supported buying this company. It was like seeing that beautiful $1 million home selling for 1.5 million. You may be in love with it and you might want to live in it, but paying too much for it could hurt your finances. This is not a financial advice to buy or sell Meta or a home for that matter. This is just to illustrate how your emotions can get in the way of your financial success. So don't let it. Find a process that will help you make financial decisions. Watch this next video to learn about different investing strategies.